Hello and welcome to Outlook Money's Investment Made Easy podcast series. This episode is led by ICICI Prudential Asset Management Limited under the Investment Awareness Initiative of ICICI Prudential Mutual Fund. I'm Versha Jain from Outlook Money and your host for this session. Welcome to this episode in our series where we discuss the complex financial world's intricacies and bring insight to enhance your financial understanding and overall well-being. This episode is brought to you in association with ICICI Prudential Management Company Limited, and today our discussion will be around the Exchange Traded Fund or ETFs. ETFs are traded on the exchange like stocks, but resemble mutual funds as they consist of a bundle of stocks. Unlike most mutual fund schemes, ETFs are passive and aim to mirror the portfolio of an underlying index, striving to generate the same return as the index. ETF prices change throughout the day, in contrast to the NAV per unit determined by mutual funds at the end of the day. As of May 31st, 2024, there were around 1.45 crore ETF folios. Clearly, ETFs are one of the favorite investments, with only few schemes in the growth and equity oriented category, such as small cap funds or ELSs, surpassing this number of folios. Since the first ETF was launched in India in January 2002, there are now a total of 2,209 ETFs, including 17 gold ETFs. As the space evolves with more players offering different types of ETFs, today we are here to delve deeper into understanding these, their different types, and whether they should be part of investors' portfolios. To shed light on this, we have with us today Mr. Amit Vashisht, lead ETF ICICI Prudential AMC. Welcome, Mr. Vashisht, to this episode.
Thank you, Varsha, for the introduction.
Let us commence the session now. To begin with, please explain how AMCs choose an index to base their ETF on, and how ETFs are created.
Sure. So AMCs typically choose an index for their ETF based on multiple factors, such as what's in the market demand, investor interest, and the specific investment strategy of the ETF. They may consider popular indexes like Nifty or Sensex, or they may create their own custom indexes to track specific sectors or themes. The chosen index should align with the investment objectives of the ETF and provide a suitable benchmark for its performance. Additionally, the most important thing while creating an ETF, the index which one should choose should keep in mind should have a sufficient liquidity so that it can be easily tradable on the index and a transparency to ensure accurate tracking error by the ETF. Hope give us little clarity on this side.
Yes, thanks for giving in crisp manner what ETFs are all about and how they are created. Now, for retail investors, I want to tell you that ETFs often means market cap index, like Nifty 50 or Sensex ETFs, but there are many other types of ETFs as well. So please explain for our listeners what are the main categories of ETFs in India.
Definitely. So generally, when we talk about ETFs, people generally think about what Nifty ETF or a Sensex ETF. But there are a lot of categories, and as you rightly highlighted, now we have more than 200 ETFs in the industry. ETFs are picking up and they are growing very fast in India. So we'll just highlight currently, as per regulation, what all categories are there in India. To start with, the first category is index ETFs, which just copy market cap ETFs. So what do you mean by the market cap ETFs? The ETF which only track basic on some category, whether it's a large cap ETF, which means the stocks with a large cap category, we create those kind of ETFs, Nifty 50 or Sensex. So their only criteria is on the market cap, and then we made the category. The second popular category is commodity ETFs. So these ETFs generally be a gold ETF or a silver ETF. So what these ETFs are do, they invest into gold and silver, and investors get an opportunity to investing into these without keeping it into physical form. That's second category. Third is a sectorial or a thematic ETFs. These focus specifically on particular themes like banking, infrastructure, technology, renewable energy. They allow investors to target specific area of the market they believe will perform well. International ETFs are now available in India. So some investors they want to take an exposure outside India. So there are a lot of ETFs available which are investing into US market, Europe market, or emerging markets outside India. This allow investors to diversify their portfolio geographically as well. Then we have a fixed income ETFs, which we call a debt ETFs. These ETFs invest in bonds, other fixed income securities, offering a way to gain exposure to the bond market There are liquid ETFs also if you want to park the money for 1 day, 3 day, 4 days. So there are these kind of a date ETFs also there. The category which is picking up in the retail and ultra HNI family office these days are called smart beta ETFs. So these
Mhm.
follow alternative index construction methodology, aiming to outperform the traditional market cap weighted indexes by focusing on the factors like low vol ETFs, value as a strategy, quality as a strategy, momentum as a strategy. So these are more customized ETF which follow particular model, and these ETFs are now as good as an active ETF because they keep on realigning their portfolio on a regular basis, and you will see the lot of stocks are coming in, coming out, and matching the methodology of the particular thought in which it is being created. So these are the few of the categories which are available in the Indian market as of now.
So, can we and bifurcate them as like equity and non-equity? Because I think that sectoral and thematic ETFs and smart beta ETFs, they are a part of equity.
Yes, they are part of equity.
All right. Okay. So in equity also, there are different types of market cap based and sectoral, like you said, banking and renewable energy technology, and smart beta ETFs, which are becoming popular among retail as well as ultra HNIs. So with these plethora of choices available for the equity portion of one's portfolio, what points should an investor consider when selecting an equity ETF?
So each category offers different risk return profile and investment objective. So while selecting an equity ETF, investor should consider several factors, not only one factor,
Mhm.
to make an informed decision. First of all, what's his investment objective? What's his investment goal? What's his risk tolerance? Choose an ETF that aligns with his investment objective, whether it's a long-term growth, income generation, or a capital preservation. Second is index or strategy. Evaluate the underlying index or strategy of the ETF. Assess whether they align with your investment philosophy and offer exposure to the sector's market cap or factors you believe will perform well. Expense ratio. So now in ETF, expense ratio is very important because compare the expense ratios of different ETFs. Lower expense ratio can significantly impact your long-term return as well. Liquidity is also what we highlighted earlier. Check the liquidity of the ETF by reviewing its average trading volume and bid-ask spread. High liquidity ensure that you will able to buy an ETF very close to the real-time price value. If there is a low liquidity, there is a high chance you are paying a premium to buy a particular asset class. So that's why liquidity is also very important. Tracking error. Assess the ETF tracking error, which measures how closely the ETF follows its underlying index in which you are investing. Lower the tracking error, which means you'll be able to get the exact or very close return in which index you are investing. Past performance. While definitely we say past performance is not an indicator of future results, but it can provide you insights into how the ETF has performed related to its benchmark and peers over a period of time. Diversification. Consider the level of diversification offered by the ETF. A well diversified ETF can help you reduce the individual stock risk or a sector risk. Fund size. Larger ETFs often we have seen have a lower expense ratio and a better liquidity. However, smaller ETFs may offer you higher growth potential if they are focused on a niche markets.
Mhm.
Tax efficiency. So generally, equity ETFs are treated like a equity taxation funds, and debt ETF and international ETFs are considered in India as a debt taxation. So while investing, you should see these points as well. So these points give you at least fair direction on what particular fund you want to invest in.
All right, you have named so many factors that an investor should keep in mind while considering investing in equity ETFs. Let's go to a few of them in detail. You said expense ratio is very important because in long term it can affect the overall return. So, is the expense ratio, what should an investor check? Is it always subjective or is it a number that this expense ratio is acceptable?
Okay, so basically you want to understand what kind of expense ratio one should track in.
Yes.
So, expense ratios generally on the ETF space are much lower than the any of the equity funds. So, if you see even active equity direct funds, expense ratios are in between zero point 0.9 to 1%, even 1.2. Vis-a-vis ETFs are as low as 3 paisa to around 30 paisa. So, you are almost getting at 90% cheaper than the active funds. So, generally, as a category, ETFs are on the lower side of the expense ratio. So you can see, but majority of the ETFs are generally on the lower side of the expense ratio, between 0.1 to 0.2.
Yes, so if one wants to invest in mutual fund and compare it with ETFs in terms of expense ratio are always, on a give better returns because of. having a lower expense ratios.
So yeah, so apple to by comparison, yes, expense ratio gives them an advantage of extra return, but definitely active may outperform or underperform depending upon the fund manager as well. But considering only expense ratio, yes, from day one they have an advantage of at least 1% while investing into ETFs.
All right. And for the second factor you told, it is tracking error. It's very important, and it is easy to compare also, compare it with index, the performance. But is there any, again, I'm asking, is there any number or a percentage which is acceptable in terms of tracking error?
And tracking errors, as per SEBI guidelines in equity, they say you can go as high as to 2% as a regulation, but on an average in the industry, 80% of the assets invested in ETFs are a tracking error of less than 0.1.
Less than 0.1.
Yeah, 80% of AUM currently in the funds they are invested in, their expense, their tracking error less than 0.1.
So which is quite within the acceptable limit.
Yes,
Okay,
definitely.
so investors should consider, in short, what I want to say is that 2% is the guideline, but most of the funds are tracking error is one less than 1%, which is acceptable to all. If it is going more than 2%, then it is a red flag, and then investors should be cautious about that.
We to generally say anything higher than 0.2 is also a high deviation, but it again depend upon category to category. If you talk about a popular category like Nifty and Sensex, you should expect it should be even less than 0.1. It should be 0.03, 0.04. A more illiquid like a small cap category or some of the sectoral ETFs, you might see a little higher tracking error. But again,
Okay,
majority of the industry is between 0.1, 0.2.
all right, okay. Now, could you explain what are the tax implications you have given, in short, you told us the tax implications about the equity ETFs and debt, but can you just elaborate it more? And also tell us about the international ETFs taxation, and is it different from others?
So, if we discuss only on the tax side, we'll divide into three categories. One is the equity ETFs, debt ETF, and international ETF. Or fourth, you can say commodity ETF. So, all equity ETFs, whether it's smart beta, market cap, sectoral ETFs, they are qualified as a equity taxation, like normal equity mutual fund or like equity stocks. Less than 1 year, it's a short-term capital gain, 15%. More than 1 year, you get a long-term capital gain with only 10% plus surcharge. That commodity and international now will, whether it's a short term or long term, will be added into your income. So whatever the income slab will fall into that category, whatever return you generate in these categories. So this is how it is bifurcated: equity and non-equity. All other falls under non-equity, commodity, international, and debt.
Thanks for clarifying it, Mr. Vashisht. Now, my next question comes as investors should diversify and include equity, debt, and commodity in their portfolio. This is to minimize their risk. So instead of direct investment in these categories, one can use ETFs to mitigate risk and enhance diversification. In the
Okay.
diversification trail, one may even consider investing in international ETFs. So, is there any particular point to consider while investing in these international ETFs?
Sure. So, international ETF you're investing, there are multiple factors which you should keep in mind while investing into international equity ETF. You have to be more careful in which country you're investing, whether it's that country is geographically stable, you might be taking too much of a risk. Then you have to see the ETF which you are investing, is liquidity available in that particular international ETF or not? Because that's also a concern. Investing into an ETF, but when you find that there's no much of liquidity, you might be buying at a 4% or 3% higher than the normal price. So generally, we have seen while investing into an international ETF, there's a liquidity crunch sometimes. Like currently, you can't even invest in international equity because there is a SEBI guideline. Whereas or not, they have not allowed the upper cap has been touched. So you currently, if an investor want to invest into international ETF, there is no liquidity available from the AMC side. So that's why you're seeing a lot of spreads are increasing in these international ETF. So liquidity is very important while investing into this. The place geography, it's very important where you're investing on that particular market, how they are placed in the long term side. Third, you have to be very careful that the taxation in international equity is a debt taxation. It's not an equity taxation. But most advantage is that you're able to diversify your portfolio outside the Indian market. That's advantage while you invest into international equity. We as a fund house, we have one fund of fund is called Global Advantage Fund. So these funds give you a flavor of all the categories depending upon whether which market is doing well. So there are a lot of investors sometimes think whether to go into US, whether to go in Europe, whether to go into China market or Japan market. So because outside India, it's a huge world. Sometimes developed countries do well, sometimes undeveloped countries do well, sometimes emerging market do well. So that's why we have also created one fund called Global Advantage Fund, which keep on doing asset allocation between these categories. So while investing, investors should be very careful in which market he is investing, what kind of a cycle that market is going on at this point in time. So while investing international, investors should be very careful while investing to get a sense that whether it's the right time to go in this market or not. We suggest you should diversify in international, take a kind of a fund which can give you all the flavors.
All right. So international ETFs are good for diversification, but there are three main factors which one should not forget while investing in it, which is liquidity and geography. How is it performing?
Right.
And the taxation part is obviously it is the debt taxation, not the equity one.
Right.
Okay. Coming to the next question. What do you think? How do market conditions affect the performance of different types of ETFs? And I'm just adding one more question here, that what is a suitable investment time for various, equity, debt, and commodity ETFs?
Okay. So should I bifurcate into two parts? First question is yours.
Yeah.
What
So the
what is
first
it?
question is market. How do market conditions affect the performance?
Okay, for all the ETFs are talking about.
Yes.
So, for example, if we are into bull market phase, you generally see equity ETFs are doing pretty well because they are broad-based market rally. You see the ETFs do very well. In bear market, you generally see stock prices are falling. So you will see a correction in the equity ETF as well. So, what we recommend for the investors that they should be a whenever they're coming into equity ETF, they should keep a long-term horizon because market is volatile. In bull market, you might see a good return. In bear market, you see a negative return. So better you stay in the long term, get a much better experience. Sectoral ETFs, you have to be more careful because sometimes even market's doing well. You have to take a call that which sector you are investing in. There might be a chance that market is doing well, but the sector you're investing might not be doing well at that point of time. Like in 2021, 22, IT was doing very well. Now you see other sectors pick, then the PSU sector picked up. So while investing in sector, you have to be very careful when to enter, when to exit. That's very important while investing to sector as a theme. Then there are a lot of defensive sectors, cyclical sectors. Generally, in the bear market, we see defensive sectors like FMC do well. So while investing into sectoral themes, client have to give a lot of thoughts before investing into as there is a place. Fixed income ETFs vary from as low as one day you want to invest, you can do liquid ETF to as high as 10-year paper also. So while investing to debt ETF, you should be very careful what kind of a duration you are buying. Higher duration papers generally are more volatile. So the yield movement can impact your return in the short term. So we also recommend in debt ETF, if you're investing for the short term, go into the liquid ETFs only. And the commodity ETF is again like silver and gold, we recommend as an asset allocation. Don't try to time this as a category because supply demand mismatch, we never know how this plays out. So we recommend when you invest into commodity ETF, you should ideally take this as an asset allocation than a tactical call. If you're very informed investor, you can take a tactical call, thinking, seeing what are the supply and demand dynamics happening across the globe and within the India. I hope this gives little clarity to the investors.
Yes, definitely it does. You have made it clear and divided it into three parts, so it is more clear. Now, my next question is, how do ETFs fit into different investment strategies, such as long-term and short-term investing? You have mentioned that debt ETFs are one should consider depending on the duration, and high term is normally more volatile. So, do tell us what uh, the ETFs, are they good for just investment, or are they good for trading as well?
Sure. So ETF can fit into various investment strategies, including both long-term and short-term investing as well.
Mhm.
While we never recommend trading, at least in the active mutual fund, even as a fund house, we generally don't recommend trading to all the investors, whether it's in ETF. But we have seen people use ETF as a tool for the trading. So we'll split into long-term, short-term, and trading. So how ETF can be utilized in different investment approaches. In long term, definitely ETF give you more diversification, so you will get to able to take the complete cycle. If you're taking into ETF, you're not depending on the particular risk. So you're diversifying your risk by taking a bigger portfolio. Cost effectiveness. So ETFs typically have a very low expense ratio compared to active mutual fund also. Even if you want to buy stocks, you're getting at a very small price, you're able to get a lot of entire stocks portfolio into one basket. So let's suppose you want to buy Reliance Industry. One investor can't buy Reliance Industry now, even if he has to more than 2,000 rupees. Whereas in ETF, in 2,000, he can get an entire Nifty basket of 50 stocks. So that's giving more cost effectiveness and giving more exposure also. And ETF being a passive investing on the long term, if you buy and hold, you can at least able to replicate the index and able to get the much better return than taking a particular stock risk. Short-term investing, again, short-term investing on the debt, we recommend if you are not clear where to park, you can use liquid as a parking avenue as a short-term investment. Or if you have horizon of less than 1 year, you can take a short-term debt funds also. Third is a tactical asset allocation, as there are some informed investors who understand macro very well and they understand how the cycle is behaving. They can take a tactical call in ETFs, enter and exit depending on if they have a view on particular sector. They think whether it's auto, pharma, depending on the valuation, they can use this as at a category for a tactical allocation rather than going on stock specific. Because generally, when we see themes, we see it's higher to take a risk on a particular stock than taking a call on a particular sector. So if you think pharma will do better, take a pharma as a ETF rather than buying a stocks. So that's some of the tactical call you can use while using ETF as a platform. The third question was about trading. So the advantage of the ETF is it's a real-time price across the day. So if you want to use some time, you can use ETF to enter at any point of time. Then over a period of time, when you want to exit, you can exit within the day also. So you can use if some of the people think there's a huge correction happened in particular sector on particular day, and they view that this is a temporary option. Then rather than going to stocks, we have seen people are using sectoral ETFs to use as a trading purpose. Although we never recommend that as a strategy, it's a very high risky strategy. But yes, these are the three categories in which we have seen investors are coming.
All right, so ETFs can be traded, but it is not recommended for the people who do not have that knowledge. So it is better to invest in ETFs as
As a
per
long.
depending on the goal, and it could be a short term in debt or in long term in equity ETFs. Okay, so my next question is that as ETFs are considered safer than direct investment in equity or other categories and offer more choices which are not available for stocks like smart beta ETFs. What, according to you, are the risks associated with investing in ETFs?
So while ETFs offer many benefits we have highlighted, such as diversification, liquidity, cost effectiveness, there are still
Mhm.
risks associated with any asset class. Same is with ETFs. Some of the risks which I just want to highlight is market risk. Like any investment, ETFs are subject to market risk. Fluctuation in the underlying securities or market condition can impact the value of the ETF as well. In volatile markets, ETF prices may experience significant swings. Tracking error. ETF aim to track the performance of the underlying index, but they may not always perfectly replicate the index return due to the factors such as expenses, transaction cost, and this will give you a little deviated return. So high tracking error can result in the ETF deviation from the benchmark. Liquidity risk. While ETFs are generally considered to be liquid investments, there are instances of a reduced liquidity, especially in the times of market stress or for less traded ETFs. So low liquidity can result in the wider bid-ask spread and difficulty in executing trades at desired rate sometimes. Concentration risk. Some ETFs may have a concentrated exposure, like if you're taking some particular hardcore sector bet, there are only 8, 10 stocks. So that's a kind of a concentration risk investor might be taking if they're entering into a particular sectors. So these are some of the major risks which I think are there in the ETFs, as when we have seen that the risks are associated with any asset class. So I hope this gives you much more clarity to the investors. Other than the advantages, what are the risks involved in ETFs?
Yes, sure. There are various advantages, but at the same time, there are various risks also which investors should consider while deciding on any of the investment avenues to put their money in. And here is my last question for you. How should investors evaluate the performance and suitability of a particular ETF for their portfolio?
So investors should consider several factors while evaluating the performance and the suitability of particular ETF of their portfolios. First of all, they should know their investment objective. So while investing in ETF, they should see that their investment objective is aligned to that particular ETF. Underlying index or strategy. Understand the underlying index in which you're investing of the ETF and evaluate whether it provides exposure to the market segment or a sector or asset class you want to invest in. Performance. Review the historical performance of the ETF related to its benchmark index and its peers. While past performance is not at all indicative of future results, but it can provide you insights into how well the ETF have tracked its index and generated returns. Expense ratio, a very big factor while investing in ETF. Consider expense ratio while investing into ETFs. But this represents the annual cost of owning an ETF. Lower expense ratio can enhance your long-term return. So look for cost effectiveness. Tracking error. Access the tracking error of the ETF, which measures how closely the ETF follows its underlying index. Lower tracking error indicates better tracking performance. Liquidity. Again, I'm repeating, but these are the points on
Mhm.
which the entire ETF is based upon. Check the liquidity of the ETF by reviewing its average trading volume, bid-ask spread. High liquidity ensure you buying and selling with a very easy and a better experience. Diversification. Evaluate the diversification benefits offered by the ETF. A well-diversified ETF can help you reduce the individual stock or sector risk in your long-term journey. Tax efficiency. Equity ETFs are taxed like a normal equity stocks. All other asset class are taxed as a income into your slabs to see tax efficiency while investing into ETFs. So these are some of the things which you keep in mind while investing into an ETFs and creating a portfolio.
All right. So there are various factors which one should consider before investing in ETFs. First of all, decide the goal for which you want to
Right.
invest, and then review the performance of the ETFs instead of the index. As you said, and I'm just summarizing it, that there are few factors. First is investment goal, then liquidity, and then the ETF's performance, its underlying index, expense ratio, tracking error, and the diversification it provides to the portfolio. With this,
Perfect.
I'm going to end it. Thank you, Mr. Vasist. I'm sure listeners have gained clarity from this discussion. Thank you for joining us today and sharing your insights with us.
Thank you, Asha. Thank you again.
It's important to note that the contents of the discussion should not be construed as the editorial recommendation from Outlook Money. With this, our today's episode of Investment Made Easy podcast comes to an end. Stay tuned to Outlook Money's podcast series for more on investment topics, and don't forget to like, share, and subscribe to stay financially informed. If you have suggestions, feedback, and questions, please do send us at letters@outlookmoney.com and stay tuned for our next edition. Until then, stay informed and keep following Outlook Money, your go to personal finance magazine.